In order to get even more value from the financial data generated through the financial statements, it should be compared with industry averages or the data of other competitors. To be able to do this, however, the information has to be put into relative terms by generating financial ratios. There are 4 categories of financial ratios, and each category provides a different level of information. There's liquidity, profitability, leverage and debt, and return to owners. Let's start with liquidity. Liquidity ratios show if the business can meet its short terms, that is less than 1 year, debt obligations. These include current ratio and quick ratio. The current ratio is current assets divided by current liabilities. The ratio informs business owners how much short-term money, less than 1 year, is available to cover short-term debt obligations. A ratio of 1 or above is normally a good indicator of the liquidity position of the company. The quick ratio is current assets minus inventory over current liabilities. This ratio serves the same function as current ratio, however, it excludes inventory, which sometimes requires a longer duration to be converted into cash. Over to profitability. Profitability ratios show if the business produces a good rate of return on its assets or business operations. The higher the value of the ratio in this category, the more profitable and efficient the company is. Those include ROA, OPM, TAT, and OIRI. Return on assets, ROA, is operating profits over total assets. This ratio shows how much profit is generated for every dollar invested in assets into the company. Operating profit margin, OPM, is operating profits divided by total sales. This ratio shows how much operating profits is generated for every dollar of sales the company receives. Operating profit is the profit generated as a result of the day-to-day operations of the company. Total asset turnover, TAT, is sales over total assets. This ratio shows how efficient a company is in using its assets to generate sales. Lastly, we have operating income return on investment, which is operating income over total assets. This ratio shows how much income, profits, is generated as a result of investment in assets. Leverage and debt ratios show the means by which the business is financing its assets. These include debt ratio and debt equity ratio. The debt ratio is total debt over total assets. This ratio shows how much is owed in debt for every dollar of assets owned by the company. Normally, the higher the ratio is, the more leveraged the company is. To be able to gain some insight into how good or bad this ratio is, it has to be compared to industry ratios or to that of competitors. The debt equity ratio is total debt over total equity. It shows the ratio of debt for every dollar of equity in the company. It helps you determine how leveraged the company is. The return to owners ratio shows whether the business makes an acceptable return on the owner's investment. This includes return on equity, which is the net profits over the owner's equity. The ratio shows the value of profits generated for every $1 of equity invested. The higher this ratio is, the more likely you are to attract external investors because they'll find the opportunity more lucrative and attractive. Now that we've discussed the 3 key financial statements, gone over a nice lengthy example, and gone over financial ratios, you're pretty much ready to be an accountant. Okay, let's not go that far, but hopefully you have a pretty good understanding of the fundamentals of accounting. Thank you, and good luck.